Decoding the U.S. monetary policy, an analytical perspective. The U.S. monetary policy is controlled by the Federal Reserve System, commonly referred to as the Fed. It plays a crucial role in defining and regulating the U.S. economy. In this video, we will take a deep dive into the mechanisms and instruments used by the Fed to manage the monetary policy. The Fed's objectives. The primary goal of the Federal Reserve is to maintain stability in the economy by controlling inflation while promoting maximum sustainable employment. This means the Fed aims to keep inflation at a moderate rate of around 2%, while simultaneously ensuring that the labor market remains stable. Policy instruments. To achieve its objectives, the Fed uses several monetary policy instruments. These tools include open market operations, reserve requirements, and discount rates. Open market operations. The most commonly used tool is open market operations. It's the buying and selling of securities in the open market by the Federal Reserve. When the Fed buys securities, it pumps money into the system, and when it sells securities, it withdraws money from circulation. These actions affect the quantity of money available in the economy, which influences the interest rates. Reserve requirements. The Fed also sets minimum reserve requirements for banks. Banks are required to keep a certain percentage of their deposits as reserves. The higher the reserve requirements, the less money banks can lend out, which contracts the money supply. The lower the reserve requirements, the more money banks can lend out, which expands the money supply. Discount rates. The discount rate is the interest rate at which banks can borrow money directly from the Fed. When the discount rate is high, banks are less likely to borrow money, which reduces the money supply. When the discount rate is low, banks are more likely to borrow money and lend it to customers, which increases the money supply. Impact on the economy. The Fed's monetary policy influences several sectors of the U.S. economy. One of these is the foreign exchange market. Changes in the interest rates affect the value of the U.S. dollar in the global market. Another sector impacted by the Fed's monetary policy is the stock market. The stock market is sensitive to changes in interest rates, as interest rate movements can affect corporate earnings, which in turn impact stock prices. Lastly, the monetary policy influences the housing and mortgage markets. When the Fed reduces interest rates, mortgage interest rates tend to decline, making homeownership more affordable. On the contrary, when interest rates increase, it becomes more expensive to borrow for purchasing a house, reducing demand. Challenges. Managing the U.S. economy effectively is incredibly complex, and implementing monetary policy has many challenges. One of the most significant challenges is the time lag between actions taken by the Fed and their impact on the economy. Sometimes taking action too early or too late could have unintended consequences. The other significant challenge is the negative effects of inflation. When the inflation rate exceeds the desired target, it can cause economic instability, negatively impacting employment levels, purchasing power, and the overall health of the economy. Conclusion. Decoding the U.S. monetary policy is an intricate process. The Fed uses several policy instruments to manage the economy and achieve its objectives. Moreover, the Fed needs to be proactive while considering the time lags and unintended consequences of its actions. Want to learn more? Visit our channel ZZ.